Friends, I am Vijay Kumar, Deputy Secretary in the Government of India. In my second talk on General Financial Rules, I will discuss first two chapters of the book. Rule 2 of Chapter 1 contains definitions of authorities, systems, processes, institutions, financial terms, etc., which have their definite role in the financial matters. Definitions of accounts officer, administrator, audit officer, competent authority, comptroller and auditor general, controlling officer, drawing and disbursing officer, head of the department, head of office, president, etc. are, in fact, definitions of authorities who have their distinct, defined roles in the financial matters. Appropriation, re-appropriation, recurring expenditure, non-recurring expenditure, CAPEX model, OPEX model, etc. are similarly definitions of financial processes. Department of the Government of India, Ministry of Finance, Government, Local Body, Reserve Bank of India, etc. are institutions. Consolidated Fund, Contingency Fund, Local Fund, Primary Unit of Appropriation, Public Account, etc. represent financial systems and processes. Financial year, public works, etc. are popular terms used in financial matters. Constitution and Treasury rules are compilations of financial systems, powers, processes, etc. Some definitions, such as those of administrator, appropriation, Ministry of Finance, non-recurring expenditure, primary unit of appropriation, re-appropriation, recurring expenditure, subordinate authority, have been borrowed directly from the DFPR. Though all definitions are important, yet some definitions, like those of competent authority, controlling officer, drawing and disbursing officer, local body, public works, Reserve Bank of India, CAPEX model, OPEX model, etc., need to be given special attention. It may be noted that the definition of public works as given in the GFRs and as given in DFPRs differ a lot. The term local body has to be understood a little deeply. It refers to the local government below the level of the state governments. India is a federal republic with three spheres of government: central, state, and local. There are urban local bodies called municipalities and rural local bodies called panchayats. Municipalities include municipal corporation, that is Nagar Nigam, municipal councils, that is Nagar Palika, and municipal committee, that is Nagar Panchayat. Similarly, panchayats include gram panchayats at village level, mandal or block panchayats at block level, and Jila panchayats at district level. These local bodies discharge their functions from the local funds under their control. Now the rules. Though the central government is divided into various departments, it is a single institution. Therefore, there may be several instances wherein a decision, if taken in one department, may affect the transaction of businesses allotted to another department. Such cases necessitate interdepartmental consultations between departments of the Government of India. For such cases, Rule 3 provides that no order shall be issued until all such departments have concurred, or failing such concurrence, a decision has been taken by or under the authority of the Cabinet. Framing of departmental regulations of financial character and modification in the systems and procedures established by these rules by other departments need approval of the Ministry of Finance. Interpretation of any of the provisions of GFRs also comes within the purview of Ministry of Finance. Further, the systems and procedures established by these rules are subject to general or special instructions, orders, which the Ministry of Finance may issue from time to time. For these provisions, please refer to rules 4, 5 and 6. Now the general system of financial management as given in chapter 2 of the book. The financial management involves bringing of government money into government account without any delay, observance of prescribed receipts and accounting rules for credit and withdrawal of government money, prompt and correct assessment and timely collection of government money, and its prompt credit to the Consolidated Fund or public account as the case may be, etc. For these provisions, please refer to rules 7, 8 and 9. Here, I would like to give a brief account of the Consolidated Fund of India and the Public Account of India. Constituted under Article 266, Clause 1 of the Indian Constitution, the Consolidated Fund of India is the most important of all government accounts. All revenues received by the government by way of direct taxes like income tax, corporate tax, and indirect taxes such as GST, customs and excise duties, dividends and profits from public sector undertakings, disinvestment receipts, debt repayments and loan recoveries flow into the Consolidated Fund of India. All government expenditure is made from this fund, except exceptional items which are made from the Contingency Fund or the public account. Most important thing about this fund is that no money can be withdrawn from it without the Parliament's approval. On the other hand, constituted under Article 266, Clause 2 of the Constitution, Public Account of India accounts for flows for those transactions where the government is merely acting as a banker. There are five major heads of accounts under the Public Account of India. First, a small savings, provident fund, and other accounts. Second, reserve funds. Third, deposits and advances. Fourth, suspense and miscellaneous. And fifth, remittances. These funds do not belong to the government. They have to be paid back at some time to their rightful owners. Because of this nature of the fund, expenditures from it are not required to be approved by the Parliament. As the responsibility of the controlling officer is to control incurring of expenditure and or the collection of revenue, he shall arrange to obtain from his subordinate officers and accounts officer monthly accounts and returns in suitable forms. Further, concerned departments shall lay down detailed rules and procedure regarding assessment, collection, allocation, remission and abandonment of revenue and other receipts. Amounts due to government shall not be left outstanding without sufficient reasons, and where such amounts appear to be irrecoverable, the orders of the competent authority shall be obtained for their adjustment. Refer to Rules 10, 11 and 12. Unless especially authorized by any rule or order made by competent authority, no sums shall be credited as revenue by debit to a suspense head. The credit must follow and not precede actual realization. Finance Ministry shall be kept fully informed of the progress of collection of revenue by a department of the central government. An administrator or a head of a department responsible for its collection. When the maintenance of any rentable building is entrusted to a civil department other than the Central Public Works Department, the administrator or the head of the department concerned shall be responsible for the due recovery of the rent thereof. Refer to Rules 13, 14 and 15. Every authority having the power to impose and oblique or realize a fine shall ensure that the money is realized, duly checked and deposited into a treasury or bank as the case may be. Similarly, it is to be ensured No double refunds of amounts are made. Accounts officers shall watch the realization of miscellaneous demands of government, not falling under the ordinary revenue administration, such as contributions from state governments, local funds, contractors and others towards establishment charges. A claim to revenue shall not be remitted or abandoned save with the sanction of the competent authority. Refer to rules 16, 17, 18, 19 and 20. General principles relating to expenditure and payment of money have been provided from Rule 21 to Rule 32. Rules 22, 23 and 32 have been borrowed from the DFPR. Therefore, I will not repeat them. Rule 29, which is about procedure for communication of sanctions, is a very lengthy rule. It provides in detail various protocols to communicate to the audit officer and the accounts officer various kinds of financial sanctions and orders issued by a competent authority. As this rule is quite simple but too lengthy, due to time constraint, I am skipping this rule. But this rule is important. Accordingly, I find rules 21, 24, 25, 26, 27, 28, 30 and 31 worth mentioning in this talk. Rule 21 provides that every officer incurring or authorizing expenditure from public monies should be guided by high standards of financial propriety and should also enforce financial order and strict economy and see that all relevant financial rules and regulations are observed by his own office and by subordinate disbursing officers. Rule 24 provides that all draft memoranda for Expenditure Finance Committee or Public Investment Bureau or Committee on Establishment Expenditure and Cabinet Committee for Economic Affairs or Cabinet shall be circulated by the Ministry or Department concerned after consultation with the concerned financial advisor of the Ministry or Department. A confirmation to this effect shall be included in the draft memorandum at the circulation stage. Rule 25 provides that all sanctions to the expenditure shall indicate the details of the provisions in the relevant grant or appropriation wherefrom such expenditure is to be made. Whether such expenditure can be made by valid appropriation or re-appropriation, or the sanction should specify that such expenditure is subjected to funds being communicated in the budget of the year. In terms of Rule 26, the duties and responsibilities of a controlling officer in respect of funds placed at his disposal are to ensure that the expenditure does not exceed the budget allocation, that the expenditure is incurred for the purpose for which funds have been provided, that the expenditure is incurred in public interest, that adequate control mechanism is functioning in his department for prevention, detection, of errors and irregularities in the financial proceedings of his subordinate offices and to guard against waste and loss of public money. Rule 27 provides that all rules, sanctions or orders shall come into force from the date of issue unless any other date from which they shall come into force is specified therein. Further, orders sanctioning the creation of a temporary post should, in addition to the sanctioned duration, invariably specify the date from which it is to be created. Rule 28 provides that a subordinate authority shall not, without the previous consent of the Finance Ministry, issue an order which involves any grant of land or assignment of revenue or concession, grant, lease or license of mineral or forest rights or rights to water, power or any easement or privilege of such concessions, or involves relinquishment of revenue in any way. Rule 30 provides that a sanction for any fresh charge shall, unless it is specifically renewed, lapse if no payment in whole or in part has been made during a period of 12 months from the date of issue of such sanction. Exceptions provided by this rule are as under. When the period of currency of the sanction is prescribed in the departmental regulations or is specified in the sanction itself, it shall lapse on the expiry of such periods, or when there is a specific provision in a sanction that the expenditure would be made from the budget provision of a specified financial year, it shall lapse at the close of that financial year. Or third, in the case of purchase of stores, a sanction shall not lapse if tenders have been accepted or the indent has been placed within the period of 1 year of the date of issue of that sanction, even if the actual payment in whole or in part has not been made during the said period. Rule 30 provides that a sanction in respect of an addition to a permanent establishment made from year to year under a general scheme by a competent authority or in respect of an allowance sanctioned for a post or for a class of government servants, but not drawn by the officers concerned, shall not lapse. Provisions relating to defalcation and losses have been provided from Rule 33 to Rule 38, such as report of losses, fixing of responsibility of losses, and disposal of cases of losses. In terms of Rule 33, any loss or shortage of public monies, departmental revenue or receipts, stamps, opium, stores or other property held by or on behalf of government, irrespective of the cause of loss and manner of detection, shall be immediately reported by the subordinate authority concerned to the next higher authority, as well as to the statutory audit officer and to the concerned principal accounts officer, even when such loss has been made good by the party responsible for it. Cases involving serious irregularities shall be brought to the notice of financial advisor or chief accounting authority of the ministry or department concerned and the Comptroller General of Accounts, Ministry of Finance. All cases involving loss of government money arising from erroneous or irregular issue of checks or irregular accounting of receipts will be reported to the Comptroller General of Accounts along with the circumstances leading to the loss, so that he can take steps to remedy defects in rules or procedures. Rule 34 provides that all losses above the value of rupees 50,000 due to suspected fire, theft, fraud, etc. shall be invariably reported to the police for investigation as early as possible. Once the matter is reported to the police authorities, all concerned should assist the police in their investigation. Rule 35 provides that all loss of immovable property exceeding rupees 50,000, such as buildings, communications, or other works caused by fire, flood, cyclone, earthquake, or any other natural cause, shall be reported at once by the subordinate authority concerned to government through the usual channel. All other losses should be immediately brought to the notice of the next higher authority. Rule 36 provides that after a full inquiry as to the cause and the extent of the loss has been made, the detailed report should be sent by the subordinate authority concerned to government through the proper channel. A copy of the report or an abstract thereof being simultaneously forwarded to the Audit Officer and Pay and Accounts Officer. Rule 37 provides that the departmental proceedings for assessment of responsibility for the loss shall be conducted according to the instructions contained in Appendix 1 and those issued by the Ministry of Personnel from time to time. Rule 38 provides for prompt disposal of cases of loss by taking action at each stage of detection, reporting, right of final disposal, in cases of losses including action against delinquents and remedial measures completed promptly with special attention to action against delinquents and remedial measures taken to strengthen the control system. Rules 39, 40 and 41 relate to submission of records and information to audit as well as to accounts officers. All reasonable facilities to the audit officer and pay and accounts officer shall be provided for the discharge of their functions, including furnishing of fullest possible information required by them for the preparation of any official account or report, payments and internal audit. A subordinate authority shall not withhold any information, books or other documents required by the audit officer or accounts officer. If the contents of any file are categorized as secret or top secret, the file may be sent personally to the head of the audit office specifying this fact, who will then deal with it in accordance with the standing instructions for handling and custody of such classified documents. With this brief account regarding first two chapters of GFRs 2017, I would like to conclude my second talk. In my next talk, I will cover chapter 3, which is on budget formulation and implementation, and chapter 4, which is on government accounts. This talk will cover from Rule 42 to Rule 129. I thank you for patient listening.